Hey everyone, as we enter 2022, investors are trying to balance all the risk factors we keep hearing about in the news. The top economic concerns include COVID, inflation, and rising interest rates. This week, I'm going to look at the different risk factors and highlight how 9 different commercial real estate property types rank compared to each other in terms of that risk. For this video, I'll set aside the interest rate risk because it pretty much affects all commercial real estate in the same way. There's not much differentiation between property segments. I'll tackle COVID first. The risk appears to be decreasing, but they're definitely still out there. This risk has the most impact on seniors housing, hotels, particularly full-service hotels in major urban centers that cater to business travelers, and to a lesser degree, office and multi-tenant retail. COVID has actually boosted demand for self-storage and multi-family housing in many markets, so this risk factor has actually been favorable in some situations. Now, for the risk that investors are watching most closely, inflation. In general, hard assets like commercial real estate tend to be a relatively good inflation hedge, but each property type has unique nuances in terms of how it interacts with inflation. I'll start with office properties. They have general inflation resistance because their values tend to align with replacement costs. They also mark to market upon tenant turnover, and some properties may have inflation escalators built into lease agreements, but many don't. Tenant quality can also influence office property inflation risk. On a scale from 1 to 10, with 1 meaning there is little or no risk, office properties have inflation risk ranging between about a 3 and a 5. Multi-tenant retail has characteristics similar to office. Leases tend to be long, but they could have provisions tied to sales, which offer additional inflation resistance. I'd rate multi-tenant retail inflation risk between 3 and 5. Single-tenant properties, particularly those leased to high credit tenants, typically don't have inflation escalators in their leases. So there is some inflation risk. Again, the risk depends on the tenant, but it's in the 3 to 5 range as well. Seniors housing, depending on the subtype and whether revenues are predominantly market rate or if they're reliant on government programs like Medicare or Medicaid, which generally have an inflation escalator in their agreement. Seniors housing generally has a greater ability to move with the market, so the inflation risk rating is in the 3 to 4 range. Medical office may or may not have inflation escalators depending on the tenants. Larger healthcare systems likely don't have an escalator, but they may have lower credit risk. Medical office inflation risk is low in the 2 to 4 range. The next 3 property types have particularly good inflation resistance because their rents mark to market frequently. I'll start with the apartment sector, which generally renews leases at least once a year. There could be modest risk depending on the tenant profile, but I rate multifamily inflation risk between 1 and 3. Self-storage properties usually have the ability to reset rents monthly. This gives them tremendous inflation resistance, also supporting a rating between 1 and 3. And the most inflation-resistant commercial real estate property type with the ability to change rates every day is hotels. Inflation risk rating for hotels is in the 1 to 2 range depending on their location, service level, and customer profile. In closing, I want to point out that periods of high inflation tend to be relatively short, a few years or less. So this shouldn't be a primary commercial real estate investment decision driver, but it could nudge investor decisions a bit. Real estate is generally a long-term investment with multi-year hold periods, so while you factor in inflation and other short-term risks, investors need to keep their eyes on the horizon.